Welcome, everyone. Thank you for being with us this morning. Super happy to have everybody here. We're broadcasting live from New York City. Vernon, I don't know where you are. Where are you?
New York City.
New York City. I'm in Park City, Utah. Super happy to have everybody here with us today. Excited to introduce EV Charging Plus. We're grateful as usual for one of our members referring this opportunity. As you know, we can't hear or see you. We know you're there, but we encourage you to ask questions throughout the presentation. Actually, this is going to be more of a luminary series, which most of you are familiar with, where we're going to have a roundtable discussion and set the stage for what EV Charging Plus is doing. We also are going to benefit from having a few guests that are advisory board members, investors, and of course the team from EV Charging Plus. So we're going to be recording this and posting it to the Family Office Insights YouTube channel. So during the session today, if there's anybody that comes to mind that would benefit from hearing what you hear today, you're most welcome to send them to the recording. And of course, we're going to make sure that everybody who is registered for this can be in direct touch with the team at EV Charging Plus. The objective of this is to lay out the investment opportunity, but more in the context of discussion about what's really going on in the EV marketplace as it relates to the charging business. I've had the opportunity to dig in a little bit and understand what's really going on here, and it's a fascinating business. One of the things that I liken it to, and Joe, you might correct me on this, but this is a new business. It reminds me of how all the businesses started funding cell towers on buildings and monetizing that, as well as outsourcing things that the real estate owners wouldn't otherwise do, which they tend to outsource stuff that isn't the primary business of a multifamily housing project, for example. So we'll get into a lot of the detail later. It's really interesting to have heard from Jake and Joe and Vernon about how rapidly the engagement has been for business development. In fact, you're going to learn during the discussion that the business development effort is not the biggest challenge. So it's always comforting to see a business that's new, that isn't challenged by having adoption. So with that, I will remind you again, please feel free to put your questions in the chat, and the Q&A will get to as many as possible. We have a lot of people coming on today, and I'm super excited that our members, a member had referred us to Jake, and then we got to know Joe and Vernon. And also as a reminder, we're going to be presenting a formal presentation next week, and more of the details of the ask and the investment opportunity, although we'll be talking about it today. So with that, Joe, you want to do some background? Sure. And Jake, if you're there, you can do that too, and then we'll get into the meat of it. Thank you all for being
here. Arthur, thank you for the opportunity. Can you guys hear me okay? Great. So very, very lightning quick background. I'm former partner of private equity in a fund called Innovatus Capital Partners. It's a $1.8 billion fund. I'm one of the founders. Prior to that, I spent, call it 25 years of consulting. I was a senior partner at McKinsey, where I did infrastructure, transportation, mobility, and real estate, and essentially left private equity to start what is EV Plus. EV Plus is, at its simplest, a standalone outsourcing option for commercial real estate owners that want to have EV charging on their property, but don't want to have any operational or financial responsibility for it. Think of us as an electric vehicle gas station with everything associated with it, all the infrastructure, all the customer service, all the maintenance, complete turnkey in a box. We come to our client's property, we open the box, and we charge drivers who have electric cars to use our system a certain amount of money, and the property, in exchange for letting us operate our standalone business on their property, they get a piece of the revenue. That's the business at 50,000 feet. This is the only, at this point, we're the only outsource option that exists for EV charging for commercial real estate. And what Arthur had said before is absolutely true. Typically, owners of portfolios of real estate outsource operational activities. They'll outsource their parking. They'll outsource the hotel management. They'll outsource the laundry. They'll outsource the telecom. In the business of commercial real estate, operating businesses is something you don't take care of. We are the first of the EV charging outsourcing options. And by doing so, we essentially unlock some of the biggest obstacles at a macro level to expanding charging infrastructure and expanding EV penetration in the United States. That's what we do at 50,000 feet.
Perfect. Bernie, you want to just say hello real quick?
Sure. Hi, everyone. Vernon Vasquez. I am the CFO of EV Plus. Quick background on me. I spent almost a decade in investment banking, primarily in JP Morgan's Mergers and Acquisitions group here in New York. And afterwards, I held senior leadership roles at a handful of startups, including Nobler, which I was the head of finance and treasurer, which was subsequently sold to USAA.
Excellent. So, Joe, we've seen the videos on X and other places where in California, there's a line 3 blocks long to charge your car at a charging station. That might be idiosyncratic to California. And then there's the other issue about, what do they call it? Distance fatigue.
Range anxiety.
Range anxiety. And of course, this is the EV charging, or the EV car trend has gotten a life of its own. Everybody's, it's kind of like, what was the story about brand loyalty of Harley Davidson couldn't have been any bigger because people put tattoos on their arms. People who drive Teslas are like religious about it.
Right.
Are you finding that? What's that?
This is changing.
Yeah.
So what you hear a lot is, EV pioneers, people buy EVs. It's no longer the case. In 2021, EVs were 2.5% of the market for new cars. In 2022, it was 5.4%. Last year, meaning ending a month ago, 9.2%. Latest forecast says next year, 13.5%. If you look at the weighted average across PwC, McKinsey, S&P Global Mobility, all these guys, fast forward the clock 6 years, 2030, and you have 30 million electric vehicles on the road. So it's not about, they may be Harley drivers that love their EVs and love their Teslas, Arthur, but this business is about the mainstream adoption of EVs in general. But because we figure out which properties to be on, we choose properties that have lots of EVs because that's where the revenue is. Yeah. Makes sense.
Yeah.
But my point being is that this is no longer a hobby. It's the game. The game is over. There's too much momentum on it. And if you don't believe it, just look to Scandinavia, look to Europe. Scandinavia has 80% EV penetration, 80. This is the way the world is going.
So the comment I made earlier in our discussion prior, one of the things we think about is business development. And aside from, and I think it would be helpful for people to know that Jake has a business where maybe we can talk a little bit about Jake's business and then talk a little bit
Sure.
how that's evolved into the ambassadors who are out there that are the natural business development arm that's evolved, which
I
allows you to
love that.
be more selective, right? Of
Yep.
which buildings to put your facility in.
So let me break that apart a little bit.
Sure.
So our natural we don't actually have any inbound sales force. I mean, I say any outbound sales force. We don't have, no one dials for dollars at EV Plus. This is a business that is straight out of central casting for commercial real estate owners that don't want to be in the operating business, which is most. They don't want to be in operating business. We are the first outsourcing option for them. So when we created a program to how do we drive sales, it was all about tapping into our existing network of friends and business relationships built over 20, 30 years in commercial real estate. It's where I come from. It's where Jake, one of my partners, comes from. And how do we use those relationships to bring us clients? So what you'll call our ambassador program is our sales methodology. We have roughly 80 people that come from commercial real estate. In fact, we have a couple of them on the phone now that have become investors, that are senior managing directors, EVPs, SVPs of businesses that are in commercial real estate. They're in the title business, they're in the mortgage business, they're in the lending business, they're commercial real estate agents, and they have 10, 20, 30-year relationships with the biggest property owners in the country. By bringing them to our program, they introduce their clients to us. So we are introduced to the CEO or the head of asset management for these large companies as a trusted and recommended solution. And in that trusted relationship is bestowed on us, and it allows us to not have to compete too hard with a product offering that is very obvious to these people. Oh, an outsourced EV charging solution. I know I need EV chargers. I don't want to ever have to think about this. Sounds good. Done. And that program started with one person. Now it's 80. And we have a pipeline of projects that is, at this point, I'd say that our sales have gone viral. It is just mushrooming because of this program.
So you mentioned competition, and we can get into it more, but is there anybody else? And by the way, I think it'd be helpful for the audience to know that the decision making, aside from it being something that they tend to outsource, is that there's no cap X for the owner. You're stepping up and saying, okay, you need an EV solution, and we're going to do the CapEx. So as a business, you're not even asking them to deploy any capital to speak of, right?
We always endeavor to be, like the I guess it's Staples has the easy button. You press the easy button and it just happens.
I love it. Yeah.
Our endeavor is to be as easy as possible by taking the financial and the operational burden from what is a relatively complex and potentially expensive amenity offering on a property, and just taking it off their plate and turn that into a passive income stream for NOI, for net operating income uplift. So we always endeavor to do that. So when they are faced with this, I know I need EV charging because my tenants, my guests, and my residents are asking for it with increasing frequency, but I don't want to get involved in it. We are the easy option. When you ask us who our competitors right now, we're the only ones doing it at scale in the United States, although I will say that the biggest competitor we have is probably Tesla. But the world is so big with so many properties that there's room for more than one, and I don't really worry about it too much.
Yeah. So let's, idiosyncratically, to have an example, have you had a building where you want to put in your infrastructure and got a no because Tesla wants to put their chargers in there?
That hasn't happened yet, but I'm sure it's going to happen.
Yeah.
But remember, they've got their eyes are on a different prize.
Yeah.
This is to them, this is extra. This is like lace. This is like paisleys around the side. This is our core business. So we think about this day in, day out. But we haven't run into them in any consequential way where it makes me worry about the business. I mean, to be honest, in 2023, which was our first full year in business, this business was called born in August of 2022. Our first year of business, we thought we had committed to our board, we would have 146 commercial properties under management, under contract, 146. We ended with 230. We have a pipeline for another 600 or 800 this year. And with our ambassador programming expanding like this, that is not the issue. The issue is satisfying the orders. The issues is executing against what people want. We've got more orders than we can handle, and it grows by the day.
So let's talk a little bit about the economic model, just so we don't have to get into the weeds, but it's basically a CapEx with a coupon, right?
I mean, Arthur, but the one thing I want to say is that yes, it's a CapEx with a coupon. You can think of it that way, but it's a CapEx with a coupon with a little operation responsibilities. We have maintenance responsibilities. We have customer service. You have to talk to drivers. There is a consumer face to this, right? There's a tech support component to it. There's a network component to it. It's a relatively complicated operational activity. And that is why the driving force isn't necessarily for our clients that they get some sort of revenue uplift, which they do. That's a nice to have. The must have is they don't have to think about it. Brain free. We handle it for them, and they convert the complicated amenity into a passive income stream.
So it reminds me of when you check into the Hilton and the internet doesn't work, don't call the front desk, call the 800 number for the internet provider, right?
That's correct.
Yeah.
We are the 800 number. Now,
Yeah.
bear in mind, the hotel is not exonerated from having a good customer experience. So they expect us to deliver good customer service, and we have to. Otherwise, we don't have long-term relationships. That is absolutely critical, right? The good thing is, and the bad thing is that the people that came before us in the world of EV charging, and some people know these names like Blink and ChargePoint, haven't exactly paved the path in a good way, and they've created a reputation for themselves with poor customer service and broken chargers, where we become really even that much easier, because it's easy when your competitors have terrible reputations for service and delivery.
Yeah, one of the things that struck me as been discussing this together over the last few weeks is that even with a nascent business, because of the deal flow, the sales cycle and things, has a continuum range, but you've been able to compress the sales cycle and say, nope, this is not a good fit for us. Let's go to the next one, right?
Right.
Which is, a cherished place to be in a new enterprise.
It's a high-class problem, Arthur. I mean, I will tell you, the first 6 months, I wouldn't say we were all comers,
Yeah.
but at this point, if we're not going to make our money back in 3 to 4 years, we're not going to do the property, even though our contracts end up being 10 to 20 years on the property. I'd rather be able to show our investors and that in 3 to 4 years, we break the hurdle. We're now cash flow positive, and it looks like your classic dividend producing, asset intensive, structured debt, cash flowing investment. Like you said, clipping a coupon.
Yeah.
I left private equity, which was an asset intensive cash flowing private equity firm with $1.8 billion. I left to do this because I saw this as the next giant asset class. It just needs a little bit of watering to get it there.
Yeah, yeah. Well, so let's talk about it. So at this juncture, you raised some money, you've executed on some properties, you're in the process of executing on more, and so you're at a point where you're saying, okay, we can put more assets on the books if we can accelerate executing on those new customers, and it would just be super helpful if we had some capital on our balance sheet to do that. Is that fair?
So and I don't, if I think about the audience here and everyone that's on this call, classic asset intensive cash flow investing is you're buying an asset and then you're clipping the coupon. For us, we want that type of a business is a debt funded business, as everyone knows, right? Like think about the mortgage business as a great example. Think about the real estate business. It's a debt driven business. We look like that eventually. So the cash that we're raising now is equity capital, which creates enough of a cushion for us to get to the point where we convert to more classic infrastructure.
Bank financing, whatever.
Financing.
Yeah.
Correct.
Yeah.
We're the first to market to do this, to create this asset class. So the equity that we raise now is enough to get us to the when you pass the threshold where now you move to classic debt financing.
Right.
This round, I hope, is the last round. Remember, I come from this world. My fund, at Innovatus, we had a $300 million venture debt fund. We had a structured credit fund. I know we just need to get there.
Yeah. So let's talk about how much and how long. And I know it's prognostication. So if you raise $5 million now, will that in 12 months get you to the point where you'll be able to just get bank debt or whatever, low cost, not have to give away any more equity in the company?
I met with Bridge Bank this morning. I met with Key Bank yesterday. We're already going down that path because those are relationships that I've had for a long time. But I know that we're more than a year away from that. Yeah. So we're looking to raise $20 million now, because $20 million buys us, at this moment, it gets us a little over a year and a half worth of cash to fund the business. Now, when I say fund the business, I'm talking 80+% of that is CapEx, is deployment of capital in physical assets into properties. The other is the OpEx, which is the people, the team, the structure, the systems required to actually run this fabulous business, right? But that $20 million number, Arthur, is a function, the faster you grow, the more you take in capital. Yeah. So,
and the sooner you get cash flow.
Exactly. So you're in this circle, right? You're in this circle. And so 20 million to us is enough to get us a year and a half. However, I look at the growth curve that we're on, and I think, should I ask for more? The answer is, I'd rather not. I'd rather just get to debt sooner, because everyone who's equity understands that they don't want the dilution, and neither do we.
Yeah,
so we're trying to be careful about that.
Yeah, naturally. Yeah, look, it's the typical entrepreneur dilemma or challenge. Shouldn't be a dilemma. Is, okay, do I give more equity today at a valuation that's painful to give that equity away? Is there some other way to do it? It's a balancing act, right?
That's correct. That's correct. In fact, look, we had some investors on the phone. I've asked. So there are people that are ambassadors. I love that term, by the way, Arthur. We haven't called them ambassadors. It's great.
Yeah, no charge. Yeah.
I've got two ambassadors on the phone. One is Steve Carvel. And Steve, I believe you're driving, but Steve Carvel, and I don't want to steal your thunder, Steve Carvel is an investor in our company. He's also the head of real estate finance at Cornell University's School of I think, sorry, I don't want to, Steve, you introduce yourself because you do a better job than me.
Yeah, I'm on. I pulled over. Thanks, Joe. This is Steve Carvel. I'm a professor of finance at the S.C. Johnson College of Business at Cornell, and I'm the director of our Center for Real Estate and Finance, an investor, and I guess I'm also now an ambassador.
Yeah.
I don't need Senate approval for it, but I'll take the title.
Right. And then, but believed in it so much is not only is he an investor in the company, he's also a client. And then we have Jillian Maruti also on the phone. Julian is also an investor in the company, and also I'm sorry, Arthur, I'm stealing your thunder. I love
No, this is your show. I'm just here
No,
to.
but I love your term, the ambassador. So
I just
Julian's
want to
another
be
our-
one. I just want to be an ambassador. That's all.
You should. Julian's one of our ambassadors. Julian, do you want to quickly introduce yourself and maybe tell everyone why you decided to invest in the company, as well as become one of our favorite advocates?
Sure. Hi guys. So by way of background, I work on JLL's capital markets team in the debt and equity. So I work closely with commercial real estate owners and developers, and I help them manage their, their financing needs. So I'll help them whenever they need to raise money, whether they're building something from the ground up or acquiring, et cetera. I mostly work in the multifamily and hospitality sectors. So they're the owners and developers I know the best. So that's my background. I had the pleasure of meeting Joe about a year ago at this point, or a little less. And I heard a lot about his business, and I just found that EV charging is definitely our future, and that this amenity on these owners' properties just made so much sense. And as Joe sometimes often would say, it's build it and they will come. I think a lot of people would have electric cars if they knew the building they lived in had a spot to charge it. And I really just believed in it. And I understand the stats that there will be 30% of all cars by 2030 will be electric, et cetera. So for all that reason, I just was really bullish on the concept, believed in Joe and the platform. So I made the introduction to a number of my owners and developer relationships. And I said to them, guys, look, I met this company. I think it's an interesting conversation. Would you like to hear more about it? Within minutes, they would say, yeah, get me on the phone with them. I want to hear more about it. And then, all you can do is lead a horse to water. And then Joe and team did the rest, explaining their business model and plan. And now a number of my clients have joined on and had Joe and team working with them on a number of installations.
And why'd you invest, Julian?
Because I believe that much into it as well. I was like, heck, if a lot of my clients are going to be hiring him and all, I might as well have a piece and skin in the game as well. So once again, just more belief in the overall product and Joe and the team.
Thank you, Julian.
Hey Joe, let me just add to that, because as from the standpoint of helping to grow the business, many of my former students own and run some of the largest hospitality companies in the world. And of course, I'm connecting them into the EV Plus network, and same as Julian just said, it's for them. It's a no-brainer. They need this, and the capital outlay for them is minimal to zero, and therefore it provides them the infinite ROI, and we get the coupon from it. The other thing that drove me to want to be an investor is that this is actually part of the infrastructure enablement for a greener future for this country.
Right.
It's the cleaner part of it. When people talk about batteries and so on, there's a lot of other complexities that go along with it. For us, this is a really clean mechanism, and by clean I mean without any effluents associated with it. To help the country get into EV enablement, as Julian was just saying, one of the biggest impediments for people in buying an EV is this anxiety about range, and even within their own homes. If you're multifamily, how many do I put in? How does it work? And EV Plus has that all worked out. So I saw it as an enablement also for the infrastructure necessary to create the path that we need for a better and cleaner future.
I love it, Steve. It makes some money in the process. Thank you.
Yeah, that's an interesting perspective, Steve, because it's a way to express an investment without buying battery technology company, for example, right? It's a way to express participating in a greener future, for example, right? They're very interesting.
I also have George Kaufman on the phone, and George is an investor in the company and has been with us since the beginning. George, are you there?
I'm here.
You want to just explain why you what made you decide to do this?
Sure. Joe's described the business model, and I think what's novel about it, and I don't think it can be stressed enough, is that at least in the US, no one else has a pure play focus on the owner operator model for these assets. In the US, the predominant model, which most people are familiar with, are the charge points and the blinks. Those are the best known, and they basically outsource some product and deliver it to a property, and then the result is that no one really owns the responsibility for the asset, and it's a one-time sale. They might have some other bells and whistles in their arrangements, but ultimately they're clipping somewhere between $100 and $500 per charger. And the result, if anybody reads the press or even has an EV and has come to find, is that something like 80% of installed base, especially from those two, and I don't mean to point them out, but they tend to come up in the press, are non-operative most of the time. And so one of the things about this business model is that there's real ownership over the asset. And so chargers that are down contribute to range anxiety, whereas chargers that are up alleviate it. And so just from a very fundamental perspective, this business model encourages uptime, because EV Plus doesn't make money if the charger's down.
That's right.
Really simply. So then on top of that, there's something more. In my day job, I'm an investment banker, and I focus a lot on go publics and public market companies. The difference in valuation that the markets attribute to companies that focus on the direct sales model, which is selling the asset and walking away from it, versus companies that have some version of an asset ownership model. And there are some, and there's one especially in Europe. Joe's already mentioned it. The valuation per charging station is ridiculous. The differential is ridiculous. So for those that flip chargers, which is basically what they're doing, it's somewhere around $1,000, $3,000 per charger. That's how the companies are valued on an enterprise value basis. For the company, excuse me, for the companies that own the charger, have some semblance of ownership, admittedly not the level of ownership that this company does. EV Plus has 10-year contracts from installation each charger, which means really a 20-year contract effectively, but even conservatively a 15-year contract. Nobody comes close to that. And yet the ones that have any semblance of ownership, they trade at multiples of, well, the average is about $100,000 per charger. So the valuation differential is amazing, and it completely makes sense, because if you have a clear cash flow stream per charger and ownership over it, and the ability to install, to apply other businesses on top of it, which EV Plus has, you can understand why that differential. So that's why I'm excited about this business model. I'm excited about all of the progress that Joe and the team have been able to push. The number of signed contracts already, frankly, astonishing, just from an execution perspective, but maybe not from a demand perspective, because again, there's nobody else providing this service in the US.
Wow. So it's Arthur here. Thanks for your comments. Is it fair to compare the valuation gap on a multiple of earnings, or is it on the unit itself? In other words, the valuation for SaaS companies, is expressed as a recurring revenue multiple, right?
Yeah, and sure. The only problem there is that there's the comps would indicate there's nothing consistent on the earning. There's no predictor. The R squared is very low if you're looking at earnings multiples for these companies. The reality is that many of them don't make money, and so it's just a hard thing to look at. But there is an incontrovertible delta between those that flip the asset versus those that own and have some version of contract. So that, in our analysis, that was the predictor of valuation, whereas earnings, just because they're frankly unreliable, wasn't. And yeah, eventually I think that, look, the way we look at it, I'll just give my short version of the way I assess this business, this specific business. This is a combination of an energy business and a tower company. So I also have some experience in my day job with cell tower companies, right? I think those are really well understood these days. Everybody understands that those are very long-term assets, and that whoever controls them, you basically make your margin by adding additional carriers to a tower. That's really the entire business model. But because of the expected longevity of those relationships, irrespective of the contract, because of the limited number of towers that can be installed in any given geography, they trade with cap rates that have been lower than treasury rates. Right? I think people are probably familiar with that. If you look at towers, they are generally viewed as some of the safest cash flows, safer sometimes than the 30-year treasury. That's how they trade. So yes, to your point, that's what this is. You're basically installing some of those. Each individual asset is less expensive, but in aggregate, they're probably worth as much or more, especially now that towers are arguably, and I'll just say arguably, going to be disintermediated, at least partially, by satellite communication. So we don't face that, or at least this company doesn't face that, and this industry probably doesn't face that, because there isn't another technology that's going to come along and displace charging in place. Even if you're using inductive charging, it still has to be in a place. It has to come from a wall. So until that's fixed, which is physically not going to happen, this is the industry. And so you look at it as a combination of the tower industry, long-term cash flows, and combined with the power industry. And the power industry is really interesting, especially when talking to end users. I think most people are familiar with getting their energy bill every month. Mm-hmm. Most people understand that it fluctuates. Most people don't pay attention to it. And that's the reality. And that's also done quite a bit of work in that sector. And so what's interesting here is that you've got a tower oligopoly plus inelastic consumer behavior in pricing for the actual kilowatts. Combine them together, you basically have extraordinary margin potential only on the base business. Again, there are other businesses that can be added with this type of scale, in conjunction with, basically, for the purposes of business, extremely long-term contracts. So that's how I look at it. And I just don't. There isn't another competitor in the space yet. Obviously, we anticipate that somebody will figure this out other than just this company, but nobody's doing it yet. And part of it is because it's just so easy to be in the flip business. But of course, the flip business is basically, cannibalizing itself right now.
Thank you, George.
Yeah, George, the nuance I hadn't thought about is that the cell tower business, safety is a function of the counterparty risk, which is Verizon, et cetera, right? Because they're just paying the rent. In the case of the chargers, there's an upside, right?
Correct. We get our usage rate goes up. Remember, if a property needs 4 chargers today to satisfy demand, that demand in 10 years' time is 20 chargers. We have exclusives on the property. Those chargers get used more and more and more up until the point where they need to add more physical chargers, and then we add more, and then they grow in usage. So every single property gets more valuable by the day.
Yes, embedded growth, right?
Right. That's why when we talk to investors, we grow at a multiple of the EV penetration growth because we choose the geography. So if the U.S. market's EV electric vehicle population, and let's just say it's growing at 30% per year, if we're selecting our properties, we're selecting the properties that are growing faster than that national average. So our revenue line will grow faster than the national average.
Yeah, so aside from the capital, the challenges that you have, aside from raising the capital to satiate the demand, what other challenges are you facing?
So number one, the biggest challenge we face is satisfying the orders that we have and the orders that are coming in at the pace that they're coming in. That's job number one. And I think that is the biggest risk to the business. The implementation risk, we've got a great team. Our head of operations comes from the world of startups, has his Wharton MBA, comes from Lockheed Martin, where he was an ops guy. So we're in good hands on the operations. If you think about exogenous risks to the business, and trust me, we think about this constantly, it is if someone figures out what we're doing sooner rather than later and has a proven if Tesla decides they want to really go into space, that's a problem for us. If you believe that the world is not big enough so that you're basically share shifting. My view is with the market that's growing as fast as it's growing, there's plenty of room for us. And once we have our installed chargers, we're on that property for 20 years. So they can't take it away from us, right? People ask about technology risk. The biggest thing that we get asked by our clients is what about the technology risk? What's going on? What happens? I don't want to buy a Betamax recorder when everyone's on VHS.
Yeah.
Spent a lot of time on that, have had a lot of conversations with a lot of people in markets that are far more advanced than ours, and I keep getting the same answer back, is until it's not about the only real advancement you'll see is how fast a car can charge, and that's not the charger. The gating item on the charging speed is the battery. How fast can the battery take in the charge? That's the gating item, not our technology. And those batteries that get you to 5 minutes or 2-minute charging are a decade away, at least according to everyone I've spoken to. So I don't have a lot of fear about the technology risk and the obsolescence risk. Frankly, in our model, when we're on a property for this long, we assume we swap out the chargers every 7 years. It's built into our model. Technology changes. They want to have something better. It's got this bell. It has
Things
this
break, right?
Things break.
Yeah.
But we have another line item in our model for maintenance. But the replacement, when technology is migrated, is once every 7 years, which is in line with the DOE suggests.
Yeah.
Joe, there was a question in the Q&A about solar. If you could address that, if we could use solar to potentially power our EV chargers.
So some secret sauce, Arthur, is our contracts, and whoever asked the question, in our contracts, we have the right to install solar and battery as part of our installation. We haven't pulled that trigger yet. Obviously, putting a solar array on someone's roof is a bigger endeavor, and you probably have to get more than just saying, "Hey, I have the right to do it on this contract," because easements are required. That's more complicated. But the answer is yes, particularly in developments where they're already oriented towards that, and they want to be off the grid or they want to offset their electric costs. We would love that. It reduces our cost.
Yeah. Totally makes sense. So I want to remind everybody that on the 19th next week, we're going to be going deep into the investor pitch and having another session. So just a reminder to everybody. Any of the guests that have come on today, which we super appreciate, like to have some final comments before we wrap things up here today. Jillian, you want to just say hello again?
Sure. Like I said, my clients have been extremely pleased with the business model and have signed contracts with Joe already, which I think is a testament to the business model. And I'm invested because I believe in it. So I'm along for the ride.
Super. Steve, are you still there?
Yes, I am. Sorry for the road noise, if there is some, but I am obviously an excited investor. My clients, the people who are signing up with me, they're just now all lining up, and the program that EV Plus is running is going to have them up and running really soon. And from every single client's point of view that I've spoken to, they think it's almost too good to be true for them, and they're excited to have more and more of it.
Excellent. Thank you. George, are you still there?
I'm still here. Yeah, I think I got through the way I analyze the business, and obviously I think it's extremely exciting. It's effectively a blue sky business supported by a ton of government incentives, not just in the U.S. but in North America in general, and all of that is on top of what is a tremendous long-term cash flow and, you noted, growth business. So I don't know too many places where you find those.
Yeah, excellent. Thank you. So, Joe, you want to have a wrap-up comment, and then we'll remind everybody again about the 19th, and also wrap it up for today. And this has been super helpful. So we have one quick question. Hang on one second. Can the tech adopters accommodate the various plugs used by EV manufacturers, or Tesla only?
All systems. So it's the right question to ask. If you had asked me this question a year ago, the way we would handle it is we would use the J1772, which is the universal adapter, because when people buy Teslas, they get an adapter, they put it in their glove box, and that allows them to use any charger. But now that almost all car OEMs have moved over to the Tesla standards called NACS, NACS, that means we no longer have to have a J1772. We move to NACS, and we're doing that now. And then we have an adapter for anyone who's in that 2 or 3 year window where people are using the J1772, which is not a lot of cars. We solve for the majority. But the answer to your question, we can handle all cars.
Awesome. Great. Joe, this has been super helpful. I'm really grateful that you had all your ambassadors, investors, and fans on the call. I think it'll give the audience insight into what's really going on here. So you want to wrap it up?
Sure. What I can say is, look, it's a better mousetrap for the world of commercial real estate. It's proving to be the more interesting solution for commercial real estate. It creates a long-term cash flow, which makes it essentially a financial asset over the long term. And it's designed to be very friendly for investors that are looking for long-term durable cash flows. Once we get past this first, call it 1 year patch, where we have to use enough capital to get to the point where we can get structured debt financing. And what I would say, to what George had reflected on earlier, is the multiples for this kind of a business are amazing. We have $100 million now under contracted contribution margin in 2023. By the end of 2024, that number is more like $350 to $400 million of contracted contribution margin, and there's upside on top of that. We know we've got a good ticket here. We just want to have enough runway with equity investors to get us to that point where we can flip it over to debt.
Excellent. Well, thank you all. And Vernon, thank you. And thank you as the guest for being here. And as, again, a reminder, on the 19th, we'll be doing this again and sending out the recording and putting everybody in touch with Joe and company. And one of the things I love about this is you can select your customer. Like, when do you get the opportunity to do that, right? So with that, as I always say, thank you for spending with us the only thing you can't make more of, and that's your time. Until next time. Thanks, Joe. Thanks, Vernon. Thank you, everybody.
Thanks, everyone.